Hi guys, welcome back with me. Don't forget to like, comment, share, and subscribe. Card of the day. Difficult to remain optimistic on Nasdaq. Although the US markets managed to eke out gains on Thursday, there are plenty of reasons why stock could be heading lower. Before discussing the macro reason, let's start with the technicals, as after all this is meant to be a card-based analysis. Hanging Man. On Tuesday, we got the first indication that the bull trend was beginning to weaken the Nasdaq from a hanging man-like candle that day, which was then followed on Wednesday by the print of a large bearish candle that took out short-term support around 1,350, a level which has since turned into resistance. Thursday's indecisive price action is perhaps a positive sign, but if the law of Thursday range gives away, which is what I'm expecting to see, then I would imagine more technical selling will be the outcome. Perhaps the potential sell off might wait until next week, but we have certainly had some tentative bearish signals after the big recovery. Nasdaq weeks compared to other US indices. The tech-heavy Nasdaq has been the clear underperformer among the US indices in the rebound that started in June, which makes it the most vulnerable. Other US indices have outperformed, underscoring the view that falling government bond rates are bad news for low dividend yielding technology stocks. The Dow, for example, has already reached its 61.8% Fibonacci retracement level against its all-time high. While the Nasdaq is now here, near us, it has barely passed the shallow 38.2% level. What's more, the 200-day average, which on a side note now has a downward slope on all major US indices, has already been reached and breached on the Dow, Russell, and tagged by the S&P 500, but not the Nasdaq. This If the markets are going to start falling, then shorting the already weak Nasdaq will make more sense than something like the Dow, which has been propped up by the energy sector. China slowdown. Concerns about falling economic activity in China were underscored by those poor macro points on Monday. Repeat lockdowns due to its zero COVID policy have hampered growth in the world's second largest economy. China's equities have been underperforming for quite a while now and led this year's drop in global markets. Worryingly, we have seen renewed weakness in China's market since the start of July, while markets in the West have rallied. If this year's earlier sell-off is anything to go by, then then dismiss the China's equity market weakness at your peril. I think that's all from me. Don't forget to like, comment, share, and subscribe.